This chapter introduces you to the concept of aggregated demand, aggregated supply. We will explain the shape of the aggregated demand and the aggregated supply curve. And we'll explore also all the forces that cause them to shift. Throughout the chapter, we will look at equilibrium level of price and real GDP. There will be also consideration on the effect of shift in aggregated demand and or aggregated supply curve on the price level and the size of real GDP. Keep in mind that the chapter is a variable price variable output model, and it's a little bit different from the previous one that we lectured. Okay, and throughout the chapter, when we cover the aggregated supply, you will see that we will review the immediate short run and how the price is set on the immediate short run. We're also going to look at the short run and the long run. Okay, the last word of this chapter will cover the Great Recession, our last Great Recession, 2007, 2009, and why the recovery from the recession was weaker compared to what was expected. So here we're the content of the chapter, we have aggregated demand, changes in aggregated demand. We'll look at aggregated supply, view all the factors that shift the aggregated supply schedule. Before we talk about equilibrium, aggregated demand and aggregated supply. And also, after we explore the equilibrium, we're also going to see how the change in the equilibrium, what are the factors that impact the equilibrium to change. So what is aggregated demand? Aggregated demand is a schedule that shows you the various amount of real domestic output that domestic and foreign buyers desire to purchase at each possible price. So, and the aggregated demand show you that inverse relationship between the price level and the real domestic output. And the explanation of this relationship is not the same as when we preview or when we view the individual demand. If you recall, when we talk about individual demand, we see the same inverse relationship between the price and the quantity demanded. But the explanation we give to that inverse relationship was that the substitution effect and income effect. Right? Here, the explanation for the inverse relationship in aggregated demand and the price level is due to a real balance effect, interest rate effect, and a foreign purchase effect. Okay, so same relationship, but the explanation is different. Okay? So the real balance effect is what? Is when the price falls, the purchasing power of existing financial balances rise, right? And that shift or that increase the spending. The interest rate effect due to the fact that a decline in price level mean lower interest rate, and that can ultimately increase the level of spending on certain type of product. And the foreign purchase effort due to the fact that when the price falls, other things remain the same. US price will fall relatively to foreign prices. Right, when that happens, we will see that increase in the spending on US export, as well as a decrease in US import. Right, because here, well, in aggregated demand, the substitution effect, right, doesn't apply, right? Because there's no substitute for all the product that we produce. There's no substitute for everything. And the income effort does not apply in this case also because income now vary with aggregated output. So now let's look at it on this graph over here. The graph depicts the aggregated demand curve. You can see the downsloping aggregated demand curve, AD, inverse relationship with the price level and real domestic output. What can change the aggregated demand? Right, the determinant of aggregated demand are what? So the factor are the consumption, because investment, the I, government spending, and net export, which is the X sub N. But all these factors will shift them. Beside the price level, all these factors will shift the position of aggregated demand. So we're gonna go through each factor and explore them individually. So the change in consumption, spending, is caused by several factors, right? Including consumer wealth, consumer expectation, household debt, and taxes, right? The second one, which is the investment spending, I, is caused by a change in things like interest rate, right? And other factors such as expected rate of return. And that expected rate of return will take in consideration the future business condition and technology, the degree of excess capacity, and business taxes. The third one is government spending. The government spend money on maintaining a publicly owned asset or do construction of a road, spending on our military, construction of a school, enroll it into the G. And the last variable, right, is changing the net export and related to price level. And changing net export can be caused by also different factors. And the first one will be national income and exchange rate. So this figure depicts the shift in aggregated demand. So originally we have AD1, and if there's an increase in aggregated demand, you will see that it will shift to the right. And ignore for now the discontinuing curve. So it shift to the right. And that's increasing aggregated demand. If it shift to the left, it's a decrease in aggregated demand. So now take in consideration the discontinuing curve, you see that the initial shift, right, a shift to the discontinuing curve, and the multiplier gonna push it all the way to 82. So if it decrease, one of the variable decrease, we're first going to decrease with the initial amount, and the multiplier that we defined in the previous selection, going to shift it all the way to the position that we have here, 83. So the first variable, the consumption, right? And what impacted consumption? We have the consumer wealth. What is a consumer wealth? There's a difference between household asset, right? The home, stock, bond, what you own, and liability, right? Payment of your loan, credit card, mortgage. So the value of the asset can change. And consumer will react by spending less, more, right? And the consumer spend more as the asset value increases. They become wealthier, they spend more money. And if the asset value decreases, consumers spend less. Household borrowing. Household can borrow in order to spend more, which will increase aggregated demand if they spend more, right? If your household reduces its spending, right, in order to pay off existing debt, so the aggregated demand they're gonna spend less, and the aggregated demand gonna decrease. Expectation of a higher income, for instance, consumer expectation that in the future I will earn higher income, right? Or higher price. Higher prices would increase the current household spending and ultimately increase aggregated demand. Expectation of lower household income or lower prices will decrease the spending and ultimately going to decrease, with the multiplier going to decrease the aggregated demand. Right. The reduction in personal income taxes, right, increase disposable income and increase spending by household. By doing so, it will increase the aggregated demand, and an increase in taxes will decrease disposable income, right, and decrease the spending, household spending, and ultimately, with the multiplier, decrease more the aggregated demand. Investment. Investment spending is a spending on a capital good, right? Increase in investment spending increases aggregated demand. Decrease in investment spending will decrease the aggregated demand. Expected rate of a return. And first, interest rate. Real interest rate is the cost of borrowing. And if that cost increase, less money will be borrowed, and resulted in less money spending in investment, and that automatically going to reduce the aggregated demand. And in the other hand, if it's a decrease in real interest, that will increase borrowing, and consequently, investment spending will increase aggregated demand. Expected rate of return, what I will earn by investing, and the expected rate of return is caused by the future business condition, technology, change in excess capacity, business taxes. Because, for instance, if the business taxes increase, it's additional expense on the business, addition to the cost of production, and that will take away from the expected rate of return. So expected rate of return is a very important factor in investing. High expected rate of return, people want to invest, people will invest more, and ultimately that will increase the aggregated demand. New technology, for instance, enhance future expected return, right? It will motivate businesses to spend more money because they are optimistic about the future, right? And that will increase the aggregated demand. If excess capacity increases, well, business will decrease current spending, and that will ultimately decrease the aggregated demand. And if excess capacity decreases, businesses will increase spending, right, in order to expand operation, and doing so will increase the aggregated demand. I already alluded to business taxes, right? An increase in business taxes, for instance, will decrease the amount of after-tax income for businesses and reduce the amount of spending that business will do, right? The amount of spending business, right? So the amount they have to spend, the capability will be reduced, and doing so, that will reduce the aggregated demand. But a decrease in business taxes will do the opposite. Government spending, other thing equal, if a government spending increases, aggregated demand also will increase, right? Example of a government spending will be spending more on transportation projects, for instance, right? And if government spending decreases, aggregated demand will also decrease. The last variable is the X sub N, is the net export spending. Right? If the net export spending rises, aggregated demand will rise. And if net export decline, aggregated demand will decline. As national income of a U.S. Trading partner increase, they will be more capable to afford U.S. goods, right? They'll be able to purchase U.S. goods, good produced in U.S., right? And doing so, the aggregated demand will increase. But if a foreign national income decline, the opposite will happen. Right? Exchange rate is another factor. If U.S. dollar depreciated, depreciation, aggregated demand increases, right? Why? Because the depreciation of a U.S. dollar will favor a U.S. Export, right? Since the U.S. product will become less expensive compared to foreign product, and foreign buyer can obtain more U.S. dollar for their currency. Conversely, if a US dollar depreciated, that will discourage import, right? That would discourage import into US, because US dollar cannot be exchanged for as much as foreign currency. So aggregated demand can decrease to change in the currency exchange rate. Currency appreciation of US dollar discourage US export, because now US good compared to other nations are more expensive, will become more expensive because the currency US dollar appreciated. Okay. So the interest rate is a major factor here on the net export. Now that we discuss the aggregated demand and look at all the factors that will shift the position of aggregated demand, then look at the aggregated supply. Right? What is aggregated supply? Aggregated supply is the schedule that shows the level of real output available at each possible price level. And the relationship here is determined on the basis of whether input prices and output prices are fixed or flexible. So we're going to look at the horizon. Yeah. So in the immediate short run, we define that in the immediate short run, both input prices and output prices are fixed. Right. The input prices are fixed by a contractual agreement, something such as a labor contract. Right. You have the factor of a minimum wage law, and the output prices are fixed as a result of a different thing, right? We have the issuance of a catalog, the menu cost, for instance, right? That is once you print out your menu and you spend that money, you are limited in flexibility to go and change the price of output, right? Just in the immediate short run, you cannot change it. In the short run, input prices are still fixed, but output prices become variable. In the long run, everything is variable. Right? In the long run, input and output prices can vary in the long run. So we're going to look at each time horizon and see how the output and the prices are determined. So this figure illustrates the aggregated supply in the immediate short run. So you can see that in the immediate short run, the aggregated supply denoted here as AS, ISR, sub ISR is just a straight horizontal curve at the economic current price level of P1. Right. With output prices fixed, right? Collectively, firm will supply output, right? A level that is demanded at the price. So the prices be fixed. They can only supply the output that the market demand at the price, P1. So if we go to the next graph, that is an illustration of the aggregated supply curve. In the short run, you will see that we have that upsloping aggregated demand supply, aggregated supply, right? And what that indicate a positive or direct relationship between the price level and the domestic output produced. And this is in the short run, you see that from the beginning all the way to full output, right? Full employment output, it kind of relatively flattened, right? Below the full employment output. And there's explanation to it because the unemployed resources and unused capacity allow the firm to respond, right? Because they already have existing capacity, they allow the firm to respond. To the price rise, the little price rise with more quantity produced because the equipment already, the capacity already exists. But after the full employment output, QF, if you look at the curve, it's relatively steep, right? Relatively steep. This is because of resources shortage. Start to experience resources because they exhaust the excess capacity. Now you will see that there's a resource shortage and it become more costly. And the slope over here, the upward slope over here is due to input prices. And rising prices over here will increase real profit. And declining prices result in declining profit. So we will look at a long run, the case of a long run, and this figure reflects that aggregated supply in the long run. Right? We already alluded to the fact that in the long run, all the prices input and output prices can vary, a variable, right? So here, the aggregated supply in the long run is a vertical at the full employment level GDP. Why? Because in the long run, wages and other input prices can go up, rise and fall, right? Can change. So the price level changes do not affect firm profit. And they create no incentive for the firm to alter the output. In the long run, also, the economy will produce the full employment output, right? They will produce the full employment output, QF, here, no matter what price level, right? Because here the profit will always adjust it to give a firm exact right profit incentive to produce exact or to produce at a full employment output level. Right? It will give them the right incentive to maintain this full employment output, be efficient. So what can change the aggregated supply schedule, the determinant of aggregated supply? or the shifter. So the determinant of aggregated supply, or the other thing beside the price level that cause a change or shift in the aggregated supply at each price level. Changes that reduce per unit production costs, right? It shift the aggregated demand to the right, right? It shift to the right, causing and the change that cause increase. The change that cause decrease in per unit production cost will shift the aggregated supply to the right. People are going to produce more. And if the aggregated or this increase, if there's increase in per unit cost, that will shift the aggregated supply to the left. So we're going to see the illustration of it. So this figure illustrates change in aggregated supply. A change in one or more of the previous determinant, or the determinant that we're going to review in the next slide, will shift the aggregated demand curve, right? The shift from AS1 to AS2 is an increase. The rightward shift is increase in aggregated demand, aggregated supply curve. And the shift from AS1 to AS3 represent a decrease in aggregated supply schedule. A change in input prices, either domestic or imported, for domestic or imported resource, will impact the aggregated supply, right? Domestic prices, things such as labor, capital, and land, right? So if the labor market, for instance, if the labor market experiences an increase in supply, the increase will increase wages, and increased wages will reduce pay. If the labor market experiences an increase in supply, what that will do, that will decrease wages and ultimately going to reduce the per unit production cost. And doing so, it will increase the aggregated supply. If the labor market experience a decrease in labor supply, right? So while that will happen, that ultimately will increase the per unit production cost, right? And will shift the aggregated supply to the left. The capital also will do the same thing, capital and land, right? So if capital and land prices shift, it will also going to affect the aggregated supply in the same way as the labor costs, right? So if the prices for aggregate supply will shift to the right, but if the prices increase, the aggregated supply will shift to the left. Prices for imported resources. Prices of imported resources. So imported resources added to domestic supplies, right, and are acted to reduce per unit production cost. And as the unit production costs are reduced, that will increase the reduction of per unit production cost will increase the aggregated supply, right? And an increase in the price of imported resources, such as oil, for instance, have to increase the per unit production cost, which will decrease the aggregated supply. Exchange rate is another factor, right? The fluctuation in the exchange rate can also change the per unit production cost, right? So, for instance, if dollar appreciated, U.S. producer will be able to purchase imported resource more cheaply, right? Reducing per unit production costs and increasing aggregated supply. And if the dollars depreciated, imported resources become costly, right? That will increase the per unit production cost and decrease the aggregated supply. Change in productivity. Productivity is what? Productivity is a real output divided by the input to use to produce the output. So change in productivity can cause change in per unit production cost. So if productivity rises, the unit production cost will fall because you found a better way to do things, to do it faster, accurately. So the unit production cost will fall. And this will shift the aggregated supply curve to the right. Right. And the inverse is true when productivity falls. When productivity falls, the per unit production cost will rise, and that will decrease the aggregated supply. The legal institution, right? A change in the legal environment can cause change in per unit production costs and change the aggregated supply. Example of a higher business taxes increases, right? Higher business taxes will increase the cost of business and reduce the short-run aggregated supply. Business subsidies will lower the per unit production costs and increase short-run aggregated supply. Government regulation is a costly for business to comply with any government regulation. So more regulation increases the per unit production costs for business and shift the aggregated supply curve to the left. And deregulation will do the opposite. This figure and the table here. So this table here show you the real output demanded in billion, the price level that the output was demanded, and the real output supply also in billion. So you can see here that once the output demanded is in line with the output supplies, we are at equilibrium. Whatever produced is exactly what was demanded, and it happened at what price level? A price level of 100. So at this level is where we have our equilibrium. So this figure show you the equilibrium price level and real GDP. Right? The equilibrium happened when the aggregated demand intersect the aggregated supply curve, right? Not equal, but one above cross. And it happened here at the real domestic output of 510 billion, and the price level is at 100. Right, the price level is 100. So this figure show you growth, full employment, and a relative price stability. Right? Normally, what happened is an increase in aggregated demand from D1 to D2 will move the economy from A to B. And real output will expand to Q2, right? And inflation will result. So you see inflation also will result from P1 to P3. Right. And what happened in late 1990 was that when the aggregated demand shift up, in the same token, we experience a higher productivity. I will spend higher increase in productivity. And that shift also the aggregated supply from AS1 to AS2. And doing so, you will see that expand the output to Q3 and kept the price or the inflation at a mild level of P2 instead of going only to P3. So the economy moved from A, instead of going to C, the economy moved from, instead of going to B, the economy moved from A to C, right? And experience a strong economic growth, full employment, and with a mild inflation. Okay, so there's one more graph that I want to explore with you on this is this one, for instance. This figure over here shows an increase in aggregated demand, right? That this increase caused the demand pull inflation. So the increase in aggregated demand from D1 to D2 caused inflation here, which is a demand pull inflation, and the price rise from the prices on the market rise from P1 to P2, right? And also, if you see here, the causing inflationary GDP gap here, which is QF minus Q1, right, minus QF, because originally we have full employment QF, and when the aggregated demand shift up, the equilibrium now shift to this level, which is represented by Q1, output produce Q1, and with a corresponding price level of P2. So you see the inflation, the price level increases, and that generate also inflationary GDP gap over here, which is a differential between the Q1 and QF. The rise in the price level here reduce what the output could be, right? It reduce the size of the multiplier effect. So think about if the price level has remained at P1, it didn't increase or remain in P1, you will see that the multiplier will work fully and the output will not be at Q1 but Q2 because of the price increase that reduce the effect of multiplier. In this graph over here, we have a decrease in aggregated demand that caused a recession, right? So if there's a decrease in aggregated demand, right, and the prices, D1, AD1 to AD2, let's say the prices are flexible or downward. So that will move the economy from QF, A, right? It will move A to C. And we represent here output of Q2 if the prices are all or the prices were flexible downward. But because prices are inflexible, right, are inflexible downward, if there's a decrease in aggregated demand, it will push the economy from A, not to C, but will push it all to B. And the B represent here output, domestic output of Q1. You see that? And now you see the reduction in the output produced. The gap is the differential between the QF, full employment, and Q1. Right. And that creating excess capacity and cyclical unemployment. Right. So the recessionary GDP gap here is a differential between full employment output and the Q1, which is when the aggregate demand decrease from AD1 to AD2. Again, here, I show you the scenario where if the prices were flexible downward, if the prices can go down, so the decline in aggregated demand in our case here will reduce the GDP or push the economy from the initial position A, right? It'll push it from A to C, but because the prices were not flexible downward, it push it from A to B. That create a big GDP recessionary gap of QF minus Q1. If AD, aggregated demand, so this is a decrease in aggregated demand, recession, and cyclical unemployment. If AD decreases, recession, cyclical unemployment may result, right? And prices don't fall easily, right? For many reasons. One of them is the fear of price war, right? If you decrease your price, or that people decrease your price, it can keep going throughout the economy until all the businesses will experience economic losses. Another reason is the menu cost. It costs businesses to release the menu, print out the menu. So once we print out, we spend a budget to print out the menu. Now it's not easy to go and change those menus and reprint a new one. Another factor is the wage contract. Once you get into that agreement, you cannot change it, right? You have to keep it, the wage, until the end of the contract. Right. Efficiency wage is another factor, right? And this is exactly why employers are reluctant to cut wages, right? Because that will impact employee moral effort, productivity. Right? Employers seek to pay efficiency wages, right? Wages that maximize work effort and productivity and minimize costs. So anything that is less than that, that will send a wrong message to the employee. And the minimum wage law is another factor also, right? And this factor usually applies to the low-skilled worker. Firm cannot pay less than the minimum wage. Okay. The last word of the chapter, I just explore the stimulus and what happened during our last recession, what was called the Great Recession. You see that the aggregated demand, the stimulus help to prevent 2007, 2009 recession from becoming another Great Depression, right? And the issue debated today is still why the recovery has been weaker than what was anticipated, what government sent those stimulus check rebate out after government spent all those money. The recovery wasn't. It was weaker compared to what was anticipated. And it's widely believed that the collapse in the housing market is the one that pushed the economy into recession. And so many bank and financial institutions fell as a result of that. And public officials compared to intervene by using both monetary and fiscal policy, try to push the economy out of a recession. So you see that the Federal Reserve short-term interest rate is pushed to almost zero in order to stimulate investment and consumption. At the same time, government undertook a massive public spending, right, to increase the demand. What all do action and help the economy, not to go through a deep, a Great Depression as what we experienced in 1930, right? But we see that the recovery was very slow, right? And some of the factors that was experienced is the growth, right, has been disappointing. The GDP growth has been disappointing after those money spent, and also the unemployment also, right? The employment rate didn't go down as expected, right? But we see improvement and overall improvement of the economy. The explanation put forward to why we didn't see the recovery as was expected when we put all those program, fiscal and monetary policy program for, was that high debt level during the bubble year that lead to the recession, right? And those debt must be paid, right? Those debt must be paid also. A related problem also focused on the fact that the increase in government spending seemed to have resulted in mainly price increase rather than increase the output produced.